Hi folks, and welcome to this next video in our series on how to earn through arbitrage and how different arbitrage models work and how we can automate them and create revenue streams for ourselves and for our clients. My name is Jared. I'm Chief Liquidity Officer for Coindex Labs. And who are Coindex Labs and who are we and how can you try our free trial? Our free trial actually is right now on hold while we recreate our market maker into a more strong offering. So the links to view the video on how you can take part in the trial or join our Discord is below. But let's take a look at the current flavor of the bot and how it's been performing since we took time to concentrate on the core offering and deliver a more stable and risk-averse bot. If we take a look at the all-time frame on this chart, you can see that the green line here, which is the Bitcoin to US dollar returns, and the black line, which is the US dollar returns, have been increasing significantly over time. And even though we nearly hit 0% returns on US dollars, it's now up. It was up above 5%, and now it's around just above 4% or 4.5%. Meaning that we will have our market maker again able to deliver for you in the near future. So today we're going to look at perpetual funding and perpetual contracts on BitMEX and Deribit and Bybit and all these other exchanges, what they are, why it works the way it does, and how we can earn through arbitrage. So what is a perpetual contract? Well, if we take a look at Deribit, we're going to see some contracts that are basically like traditional financial instruments, which expire in the future as the price, as the distance between the time in the future and now becomes shorter. The price comes closer and closer to the mark price or the spot price for that underlying symbol or item or in this case is Bitcoin. So these two contracts expire on June 26th and September 25th. As you can see, the prices aren't exactly the same. They're a little bit less in each case than the perpetual contract, and all the perpetual contract is a futures contract that never expires. It's made possible through blockchain wonders, and basically, instead of having this different price from the spot price that converges over time, we now have an instrument funding apparatus that's put into effect. So if we take a look at BitMEX, we can see that if the price diverges from the mark price significantly, the funding rate goes up or down according to whether or not we want to bring the price back up or down to meet the spot price. So right now, the funding rate is negative 0.08%, meaning that in an hour and 6 minutes, the shorts or the people that are currently selling or betting that the price will go down, they're going to pay a percentage of their holdings to the people that are longing that contract, meaning that basically it's going to incentivize people to be long on that contract and to hopefully bring the price back up. So if we take a look at the Bitcoin price of the perpetual, which is 6762, we should see that. Let's take a look here. We should probably see that future price for the perpetual is below the mark price, and we can probably find that out by grabbing the instrument data from the API and indices, I guess. No, we don't need indices. So if we try this API call here, we're going to find our active symbols. So this is the Bitcoin US dollar perpetual contract. If we look for mark price now, let's just copy all this stuff over. We're going to see the mark price is 6768, and we said that should be above the price for the perpetual contract. Oh, not by much. It looks like it's fairly converged. So it looks like the funding has actually worked in this price, in this instance, because the price has converged on the mark price, which is good news. Which means we should see in the next funding rate. Do we have predicted funding rates in here? No, we don't have the predicted funding rate. I wonder if we can find the predicted funding rate. So that we should see the next funding rate for the next 8-hour interval should be less than this funding rate. It looks like we don't get the actual next funding rate off BitMEX from their API, which is fine. Either way, we see that the funding rate has worked, and the price of the perpetual has come closer to the mark price over that last 7 hours since the last funding happened. Now we can check back in an hour to see whether or not my hypothesis is true, and see whether or not our funding rate is going to be less than 0.008. So funding rates bring a convergence in perpetual futures to the market price, which is the underlying spot price. Now, that's basically it. That's how it works, and that's why it does what it does. Now, how can we earn through arbitrage? Well, let's say we have more than one exchange. Let's say we have one exchange where the shorts are paying the longs 0.001. And let's say we have one exchange where the longs are paying the shorts, the longs are paying the shorts 0.002. Arbitrage. Well, in this case, we can see that if we were to take a long position on the first exchange and a short position on the second exchange, both of them would be earning, and one would be earning twice as much. So the difference in those is this much. So we'd be earning this much percent on an 8-hour period on most of these exchanges. Some of these exchanges like FTX and Deribit quote their rates in 24-hour periods, so it's best to multiply them out into daily rates to compare. And we can take a look at what this looks like in real time with a bot that I've created, which checks Deribit and Bybit and BitMEX. And we'll see that the rate on BitMEX is 3 times the rate that we just saw quoted on the interface. So we saw 0.8%, which is 0.008 in decimal, 0008 in decimal. If you multiply that by 3 to get the daily rate, we're going to get negative 0.02 or 0.2% on a daily. Deribit is set at 0 right now for both Ether and Bitcoin, and Bybit on Bitcoin is 0.001 or 0.1%, where the shorts are paying the longs, which means that we'd want to long BitMEX in that example for Bitcoin, or for Ether we'd want to long Bybit, because the Bybit rate on Ether is higher than the BitMEX rate, which is actually, it looks like we want to short BitMEX for Ether, but the Bybit rate is more extreme. So if we were to compare the two, based on the value difference between themselves and absolute zero, we'd see that we'd be more, we get paid more if we were to if we were to long Bybit in this example, and then if we short BitMEX and just ignore Deribit, we'd earn even more. So basically what that means is, let's say we had $100,000 on, let's say we had $100,000 total actually. Worth of Ether, we'll say. So in this case, what I want to do, because this one's shorts paying longs half as much as longs are paying shorts, we'd want to short half that balance, so $50,000 or $33,000. We want to short a third of that balance, and we want to long 2/3 of that balance to maximize our income. But what we could possibly do is actually only go half and half, and that way we wouldn't be exposed to any upwards or downwards movement in the price, because we've shorted and longed exactly the same amount on these two different perpetuals contracts, which should stay around the same mark price. And so we won't see any upwards or downwards movement because we're perfectly hedged, and now we can arbitrage the rates. And what will we earn in this case? Well, we'd earn $5 and $10 every 8 hours. Look at what that looks like with the actual rates that we saw from the API for Ether. So if we were to short BitMEX and long Bybit, and this is using real numbers from the actual exchange as it is. So we'd long with half our balance and short with half our balance. Let's say we had $50,000 in each, which isn't a far cry for some investors, institutional, retail. What we'd get is this is actually the daily rates here. So every day, we'd get a third of this per 8 hour per day. So if we were to multiply this out by $50,000, which is what we're holding, we'd get $17.35 for free just from the funding. And we'd weigh that against our BitMEX shorts, which are going to pay us $10.50. So now we've just earned $27.85 from basically not having any exposure or any risk, and perfectly balancing our shorts versus our longs and earning on that funding difference. With $100,000. So again, what was that by the day? 27.85 times 3, assuming the rates didn't change throughout the day. That's 83.55 a day, which is 0.083% per day. That's not actually that much, but you'll see that these rates are actually very, very low, and you'll see that in the future these rates can sometimes go kind of extreme. It looks like I broke the BitMEX clock because it shouldn't say 24 hours for funding here. It should be 56 minutes. But you'll see that this rate is actually very, very small, and over time you'll see a higher rate, and we'll have more arbitrage opportunities. But even if you have 0.08% daily, that's 30% APR, which is kind of fantastic for having absolutely no risk. And if you were to create an arbitrage bot surrounding this, you could create minimum thresholds to do this. You could also look at what we're talking about in other videos, which is the convergence of futures arbitrage, cash and carry arbitrage. You can actually weigh your cash and carry opportunity versus your funding opportunity, and always earn as much as you could given the difference. And that's basically that. So you have the opportunity to earn 30% annual percentage yield every single day just for holding these currencies, perfectly hedged against each other, like I said, so that a price up or down doesn't affect anything, and you just earn the funding amounts. Alrighty, that's basically that. Thank you so much, and give us a like and a follow and a share.